Hey guys, what's up? Robin here, and in today's video I'm going to be showcasing you guys my entire March 2020 stock portfolio. I'm going to be giving you guys updates. I'm going to show you guys my entire stock portfolio, so all my different stock accounts, all my different portfolios. I'm going to share with you guys everything that I've been going through, how I've been investing for the month of March. And I know this video is a little bit kind of, I meant to do this video a little bit, a couple weeks ago, and I'm sorry that's a little bit late, but nonetheless, here's my stock portfolios for March. I hope you guys enjoy them. So let's jump into the stock portfolios and let's see how things are doing. Hey guys, alright, so we're inside my Wealthsimple portfolio dashboard here, and like I said earlier, I have 3 portfolios that we're going to cover today, and we're going to cover the biggest one, which is my oldest portfolio on Wealthsimple Invest. This is the first portfolio I ever created, and I created this about, I want to say, a little bit over a year ago. It was about February-ish, March-ish last year. So yeah, about a year or so, maybe a little bit more than a year. And Wealthsimple is a Roboadvisor. So when I first got started with investing, I took the route of trying out a Roboadvisor and using that to invest my money, kind of as I learn things and learn how to do things for myself. And I still think that using a Roboadvisor is one of the best ways for anybody to invest. Like realistically, you could use a Roboadvisor, invest your money for the rest of your life, and you do fine. And I think for a lot of people, this is a good option. So if you don't want to get too technical about this kind of stuff, using a Roboadvisor is a good option for you. And it all depends on how involved you want to be. I like to do both, so I want to keep the bulk of my money in this portfolio because it has performed well. But I also do like to buy my own stocks and do my own trading and build custom-based portfolios too. So it really just depends on what you want to do. But in this portfolio is, like I said, my Roboadvisor one. This is the very first one I built. This is my biggest portfolio. It's also going to be the one I expect to kind of do the best over time. It's mostly high growth stocks, since I picked they have kind of a risk scale kind of thing, and I picked the 10, the highest one, which is the highest risk. So a lot of long-term high growth stocks with a little bit of dividends sprinkled in here and there. It's kind of like a mixture of everything, but a high emphasis on long-term stocks. So this portfolio is really geared to grow over time, and as markets kind of go down, these type of portfolios will go down with the markets, but then as markets go up, they'll also go up really high with the markets too. So it's kind of like a catch-22 kind of thing. But this is the portfolio I built. Right now, we're sitting at about $41,000. In the beginning of March, I had about this month. I haven't put much money into this portfolio throughout the month. I've been focusing on my dividend investing case studies and my real estate investing case study as well. I will link to all these portfolios in the different case study playlists in the description of the video if you guys want to check that out too. But this is a portfolio that, like I said, I've just been kind of over time just throwing kind of any free cash I have, any kind of free money I have at the end of every other day. I've just kind of been throwing in this portfolio. And as you guys can see here, when I go to my deposits little tab here, I'm just going to see if I can get deposits here just to show you guys that you don't need to have a lot of money to start investing. You can see here, guys, that I'm just putting $100 here, $100 here, $300 here, $200 here. There's some big deposits here and there as I've kind of gotten money and as I've maybe moved money around and stuff like that. But the bulk of it is $100, $200. You kind of see it just varies. Kind of whenever I have some free cash, I tend to just throw it in this portfolio. And over time, obviously, this is where we built up to where I am right now. And of course, I've been getting dividends and stuff like that. And we'll cover that since March is always a really big dividend-based month. We actually got quite a bit of dividends with this portfolio. And this portfolio, a lot has happened in the past little while. So the beginning of the month, we took a big drop. I'm actually going to see if we can get 3 months here. So we can see here, kind of around, I want to say around February, towards the end of February, we got a bit of a dip, then things went back up, and then things kind of went crashing down. And that's when, everything kind of went a little bit crazy. We had some big crash, and our account went from 43,000 all the way down to at the lowest point of 35,000. So I think that's about, it's at 8,000. I remember I was negative 8,000 at one point. That's how much of this portfolio dropped, and then it kind of went back up, and now we're kind of going back up, and it's only negative 2,000. So that feels pretty good. It feels pretty good, even though it's in a negative. But that's the whole point of this portfolio, is that when the markets go down, it's going to go down, and then when they go back up, it's going to go up really hard. And I've noticed is with this portfolio is whenever it's went down, it's always rebounded even higher than it was before. So we're just kind of waiting and kind of just keep investing our money, and we're just going to keep doing the same thing. So this portfolio, once again, I've been building up. We're sitting at about negative 2%. So negative 2% is roughly around $2,000. I'm going to go into the portfolio here, and I'm going to show you guys my holdings because it's nice to look at different things and whatnot, and just to see how things are going. So if we look at holdings here, we have 90% equity and 10% bonds here. That's pretty much the highest risk portfolio in Wealthsimple. And the way it goes with stocks, the more equity you have, which is the more stocks you have, the more risk you're taking on, in a sense that the more your portfolio is going to be going up or down. It's not necessarily more risk as if you can lose money per se, because you only lose money if you sell, right? Or if you sell at a loss. It just means that your portfolio can either go up a lot or it can go down a lot. And that's kind of what equity is. And you look at the bottom here, this fixed income tab here with 10%, these are bonds. So bonds are kind of like, they're a little more stable. They kind of work the opposite of stocks. So when stocks go down, bonds tend to go up a little bit. Not tons, but they're kind of there to balance things out. And as you guys can see here, you'll notice that the bonds are actually sitting a little bit higher. Not like crazy high, but they're, stocks are sitting at negative and our bonds are just a little bit higher. So they're just kind of there to help offset losses when markets crash. And that's in my experience, tends to go that way actually. So pretty interesting to actually see that unfold, but that's kind of the way bonds are going. And generally speaking, the more you rely on your portfolio to kind of make money or earn income, the more kind of you want to have more bonds than equity. And it's generally kind of advised that as you get older, you kind of move some of your equity into bonds, but it really depends on your financial situation, how much money you're making, how much money you have saved, and all that kind of stuff. So obviously it depends, but that's kind of the way it works. For now, I'm just going to keep this the way it is and just kind of go with this because it's working pretty good. And once again, this is for the long term, and this is in a tax-free savings account. So I'm expecting this portfolio to do really well. And if you guys do have whatever portfolio you're expecting to do the best, or whatever stocks you're expecting to do best, you should probably put that in a tax-free savings account, because that'll make you the most money in the long term, and you'll save the most money in taxes. You got to think long term, right? Because any money you make in your tax-free savings account, you can keep using year after year, so it makes a lot of sense. All right, so let's check out the different ETFs that we have in this portfolio. So once again, Wealthsimple will pick ETFs predominantly, and ETFs are basically baskets of stocks. So ETFs can hold anywhere between 50 to 100 to a couple thousand stocks per share. So it's a great way to invest. It's a great way to get started, and it's also very stable and very safe. And I think it's one of the best ways to invest. You could easily invest into ETFs and you'd be fine. And I think ETFs, for most people, are probably the best way to do it. So the first one we have here is VTI, which is a US-based ETF. This is a very standard US-based ETF. It represents 22% of our portfolio, and we have a market value of about almost $10,000, $9,000 to $10,000. So we have $9,000 in US stocks. That's 48 shares. It doesn't sound like that much, but US stocks tend to cost the most. So that's why like VTI, one share of VTI is quite a bit. I imagine it's probably a couple $100. You can see the performance is negative 3%, and this is actually pretty good. US stocks have kind of rebounded a bit, and that's because Trump is trying to pump he's trying to get the economy going. He's trying to give people money. He's trying to keep things going. He's trying to kind of get the country back going again, which I think is good in the long term eventually, as long as it's done the right way, right? So hopefully they do things the right way and they take it slow, and that can help US stocks kind of start to go up, and we can see that they are starting to go up. The next one we have is international equities. So this is kind of all across the board, I believe. This is XEF. And we have about $8,000. So again, quite a bit into international equities with this portfolio. 330 shares, so a lot more shares here. And performance is negative 12%. So this is like equities all across the world. So you can see that stocks overall are pretty down. Like most economies, most stocks, most countries are pretty down right now. And that just makes sense. When you go in, a lot of people predicting that we're going to be heading to a global recession, so it makes sense that everything is going to be down, and that's just kind of the way it is. The next one we have is EEMB, which is emerging market equities, and this is predominantly based out of Asian stocks. So think China, Korea, Japan, all those kind of places, those Asian countries, and this is sitting at 16.8%. So again, a lot of foreign stocks in this portfolio, which is kind of interesting. And we have $7,000 with 101 shares, and this is sitting at negative 10. And this is actually pretty good because I think this ETF actually has 20% of it in China, and China has recovered quite well when you think about like all the things that have been going on right now. Like I remember they were sitting at like negative 20 to 30% at one point. I checked this portfolio. They're sitting at negative 10%. So they've recovered quite a bit. They're doing pretty good considering what things are going. So this might be a good stock to buy. Because if you can buy it now while it's still priced low, when it rises, it's going to do pretty well. So pretty happy with this ETF, even though it's pretty low right now. China, it's actually doing pretty good. And I think the Asian market will kind of rebound slowly over time. It's just a question of how long it's going to take, right? Next up, we have global equities, which is 10% of our portfolio. And again, this is more a little bit of everything with a little bit more US based stocks and North American stocks. And we can see here, this one is negative 2%. In fact, I think this one is kind of mostly US stocks with a little bit of foreign stocks sprinkled in. It's kind of like all of these combined together kind of thing. And this one's at negative 2%. So again, doing pretty well. And this represents a smaller share of our portfolio. Next up we have is Canadian equities. Now, Canadian equities are kind of interesting. I don't know what's going to happen with Canadian equities over the next little while. It's kind of interesting. I think our country overall is doing okay amongst everything, but it's hard to say. Like in the past, Canadian equities have kind of been kind of so-so. Like they haven't done horrible, but they haven't done great either. Like they've always been underneath the States. But it's nice to diversify and whatnot just in case, right? And we're sitting at negative 14%. So this one is kind of lower, and the Canadian dollar has took a big hit, and that's because of a lot of like the oil stocks and stuff like that have kind of tanked over the last little while. So I think if maybe oil can kind of rebound and maybe our real estate can start to do a little bit better, maybe these can kind of increase over time. And conversely, if you look at like a lot of Canadian REITs and a lot of Canadian real estate funds, they're actually doing really well. So that's interesting. So if you're going to invest in Canadian stocks, maybe look at some REITs or some Canadian real estate since they've been doing a little bit better as opposed to traditional stocks. Nonetheless, I still think it's important to, put a little bit of our portfolio in them because over time they will grow and they have done well. Next up, we have our US equities, which is a Canadian hedge fund. Don't know why Wealthsimple has decided to use this fund, but it has performed pretty solid, negative 8%, so not too bad. Next up, we have our bonds. So ZFL is a Bank of Montreal long-term federal bond ETF. And once again, because stocks have, are down, generally speaking, this is sitting at 8.6%. So this is going to offset some of our losses. But in reality, it only represents $3,000, which is a small amount of our portfolio. Like this is like maybe 8%. It says 8% right here. So it's a small amount of our portfolio. And then we have US inflation-linked bonds here, another Canadian hedge fund, which is sitting at 4.5. So these in total only represent about 10 to 11% of our portfolio. So they're just there just because, and they do make us monthly dividends, which is nice as well. So just wanted to cover that for you guys. That's kind of our portfolio. That's kind of how things are going. So overall, everything's in the negative, but we've seen a nice little recovery. We're bouncing back kind of thing, and things are going good. Next up, let's take a peek at our dividends because everybody likes to see dividends. March is always a good dividend. March, every quarter, we tend to get our dividends with this portfolio, and also the big dividend months are June and December, since a lot of our foreign stocks pay only twice per year. So coming up next June, we should get some nice dividends when those end up going out. So let's click on our dividends and interest, and we'll look at March. I know I'm doing this video a little bit late, halfway into April. But I wanted to get it done because I've been meaning to do these monthly updates on a regular basis. I've just been really busy lately, and sorry about that, guys. But I wanted to get this video up nonetheless. So March, we have ZFL, which gave us, this is one of our bonds, gave us a $7 dividend, so that's pretty nice. Our other one, Q-Tip, another bond, ETF, gave us $1.45. And then towards the end, we got XIC, which is our Canadian stocks, gave us $44 in dividends. And then towards April 2nd, which is like the beginning of April, end of March. I'm going to count it as March because it's pretty much the same month. We have VTI, which is our US stocks, with $40, and then another ZFL payment of $7. So overall, this would be about $100-ish, give or take, that we made in dividends from this main portfolio for March. So pretty good, pretty solid. I'm pretty happy with it. Again, not much has really happened. Things are just slowly starting to bounce back, and I wanted to do this update just to show you guys how things are going. So let's jump into our dividend-based portfolio, and let's see how our dividend stocks are doing. All right, so here we are inside of our dividend-based portfolio out of Wealthsimple Trade. So I use Wealthsimple Invest as my main robo-advisor to have my main portfolio, and then I have a tax-free savings account, another one, which is a dividend-based portfolio for Wealthsimple Trade, and then we also use Wealthsimple Trade for our real estate REIT investing portfolio, which I will show you guys after this one. So in this portfolio, which is my dividend-based portfolio, I built this portfolio because I wanted to get some more regular income coming in on a regular basis kind of thing, and I've kind of like started to fall in love with dividends because I love the monthly income that you get from them and stuff like that. And I wanted to do this case study to show you guys how you can start making passive income just by simply investing your money. So I'll link to this playlist, this entire playlist for the, I have done a case study where every single week we invest money into this portfolio. So I'll link to that playlist in the description of this video. If you guys want to follow this channel, make sure you subscribe so you guys don't miss those updates. It's one of the popular series on my channel. And we have $1,659, and we are up a little bit over last month. You can see that we are up $100, so about 7% increase, but over the past 3 months, we're still down quite a bit. Like, you know, so March has been a decent month for my dividend investing case study and my dividend portfolio, but we still are kind of down a lot in this portfolio. And you can see that this portfolio is a lot more riskier than my other one, especially because it's not as diversified. And you know, the dividend, it's not a lot, like my Wealthsimple invest portfolio is all ETFs. This portfolio, we actually picked a lot of individual stocks. But the basis of this portfolio is still on ETFs. As you guys can see, here are my different stocks that have this portfolio. So we have ZWC, which is a Bank of Montreal stock. We have XRE, which is a real estate based dividend based ETF. We have XHD, which is another ETF. I think Canadian stocks. And then we have VYMI, which is I think American-based stocks, and then VDY, which is another Canadian stocks. We have SGR, which is Shaw. We have RNW, which I think is TransAlta Renewables, which is an energy stock. And then we have PIF, which is Polaris Infrastructure. So we have a bunch of different stocks with a little, like mostly ETFs with a little bit of dividend stocks kind of sprinkled in. But the main theme of the portfolio is to get dividend income, monthly dividend income. So that's the whole purpose of this portfolio. And if we check out the cool thing about this portfolio, it's a little bit more interesting, if you will, because it's got more dividends coming in. Like, and we got a lot of them. Like, we go to dividends here for the last month. We can see here that, and even with just the small amount of portfolio that we have, we actually had quite a bit of dividends for March. You can see each of these different ETFs and stocks pretty much pay a dividend on a monthly basis. You can see them all here. So there's obviously, they're not as big because we don't have as much money invested, but over time it does grow, and we are reinvesting this money back into the portfolio to keep it kind of growing and stuff like that. And it's not a lot of money, you know, it's 18 cents here, 96 cents here, but it's slowly growing. You can see when we first started, it was just small little amounts. And then you can see it's slowly starting to pick up. And then even in April here, at the beginning of April, we got a $1 dividend. We got our first $1 dividend. So, you know, but that just goes to show you guys how things just slowly over time, they keep increasing, especially if you keep investing, you keep at it. So this is this portfolio. Once again, I'll link to the entire playlist if you guys want to check out that case study. Let's check out our real estate investing portfolio on here as well. All right, so here's our real estate or REIT investing portfolio. This one is based 100% out of real estate stocks. We have $753 in this portfolio. This one is a little bit newer. We started this one over a couple weeks ago. It's not that old. I think it's about 3 months old. Maybe it might be at the, actually, if I hit all here, I think it is about like, might be around 3 months. I think it looks like we have data for 3 months, so I think it is about 3 months in here for the portfolio. So it's still a little bit newer than our other ones, but it's doing pretty good. And the funny thing about this portfolio is it's actually not too bad. It's doing much better than my other ones. We're only down $46, and we're only down at -7% all time. And this one is all Canadian real estate for now. And I'm probably going to make it Canadian real estate for the time being. But the cool thing about Canadian real estate is it has historically done really well. The ETFs are priced really cheap, and the dividends are really nice. Like, you make really good dividends with this portfolio. And here's the different ones we have. We have ZRE, which is I think a Bank of Montreal equal weight real estate portfolio. We have XRE, which is one of my favorite REITs. I actually did a video of XRE. Link to it in the description of this video. It's my XRE REIT review. Check out that if you guys want to check out that ETF. And that's from BlackRock. We have VRE, which is a Vanguard-based real estate fund. We have IRT, which is a First Asset Canadian REIT ETF. And then I think we have RioCan. Yes, RioCan, which is this REI.UN one. So once again, all these are all real estate, and the theme is to diversify with my different portfolios, and it's to just keep regular income coming in. These ETFs in this real estate portfolio is very similar to my dividend-based ones, in the sense where I want to get that passive income coming in. But with this portfolio, I wanted to mimic what it'd be like to buying like property and being a landlord, but not having to deal with all that issues of being a landlord, you know, make it a little bit more passive approach. So let's check out our dividends for this portfolio. And I think this is one of, if I want to say one of the most interesting case studies that I've done, it's definitely this one. So I'm just going to filter out, and I'm just going to go to my personal account so we can actually see here. And we can see here that these are the dividends that I've got from my personal account. So pretty good dividends, as you guys can see. Oh wait, this is have deposits in there for some reason. So let's go dividends. And you can see here we've gotten a couple dividends from this portfolio, and once again it's just slowly increasing over time. Now this one's a little bit new, so it has a little bit less, but over time these dividends are just slowly adding up over time. We're just slowly getting there, guys. Like it's slowly getting there. So that's my portfolio. That's what I wanted to show you guys, how my stocks are doing for this month. So let me know if you guys have any comments or anything about all these different portfolios. Let me know what you guys think in the comments of this video. Thanks for joining me here, guys, today. Hope you guys enjoyed this video. Hope it gave you some perspective of how I'm doing. And so you guys kind of know how things are going. And if you guys are investing yourself, don't worry that your stocks are down. This is kind of normal. Just keep pushing through, guys. Keep doing it, and you will have success. I promise you that. So thanks for watching this video, guys. Let me know what you guys think in the comments. Subscribe to the channel if you're not already subscribed. And I'll see you guys later, and take care.